Hello, today I'll be giving an overview of the new weaned calf risk protection, also referred to as weaned calf or WCRP pilot program. Just a quick disclaimer that this presentation is intended to highlight some of the features of the weaned calf policy, but is not comprehensive of every aspect and requirement of the policy. Just a quick program overview to get us started. Weaned calf was designed to provide coverage to beef cow-calf producers from revenue losses from their calving operations for calves up to weaning age. What makes weaned calf unique from other livestock insurance products that RMA offers is that it has a yield component similar to, say, a corn or wheat policy that you may be familiar with. Weaned calf has an APH that allows producers to utilize their own yield history to establish their guarantee. Also similar to row crop policies, the plans of insurance that are available are yield protection, and revenue protection harvest price exclusion. Coverage levels available are 50 to 85%, with catastrophic coverage also being offered. Producers are required to insure all insurable calves, and one important note that I want to emphasize here and will go into greater detail later is that insurance attaches at the time that the calves are included on a calf report. Insurance ends the earlier of, and these are the most common actions that cause insurance to end, but weaning, selling the calves, or the end of the insurance period date, which for the 2024 crop year is January 31st, 2025, and currently we're only insuring spring-born calves. This initial program year, we're piloting the program in all counties in South Dakota, Nebraska, Colorado, and Texas. And like I previously mentioned, we're currently only insuring spring-born calves, which for the purposes of this program are calves born between February 1 and July 31st. Weaned calf was designed with the common commercial beef calf in mind. In order to be insurable, they must be a beef type calf and would typically have a feeder cattle grade of medium or large frame and 1 or 2 thickness. Dairy cattle, miniature breeds, double muscle breeds such as Belgian Blue or Piedmontese, and specialty breeds are not insurable. So for the majority of this presentation, I'm going to go through the policy in chronological order. At the time of this recording, it's currently early January 2024. We've already passed the contract change date, which is the date we had to get the policy published by. And we are in the price discovery period. Weaned calf uses the CME November feeder cattle contract for price discovery. For the projected price, we're looking at the November contract from December 15th, 2023 to January 15th, 2024. And then for the harvest price, we look at that November contract again during the month of October. Weaned calf also has a few features that I'll cover in greater detail in the next few slides, but there's a regional factor which allows the program to recognize a regional basis for price, with a 650-pound calf being the standard base weight used for price discovery, and there's a price adjustment factor that is used to adjust the price based on calf weight. For the regional factor, we use AMS pricing regions, and South Dakota, Nebraska, and Colorado are in the north central region, along with Montana, North Dakota, Wyoming, and Iowa. And Texas is in the south central region with New Mexico, Oklahoma, Kansas, and Missouri. Here is the formula for calculating the regional factor, but essentially we're taking the AMS regional report for a 650-pound calf and dividing that by the CME futures price. Here are the formulas for calculating the price adjustment factors, and what these do is they create a price slide to adjust on a per pound basis, because we all know that the odds of having exactly 650-pound calves are slim, and lighter calves are worth more on a per pound basis, and heavier calves typically bring less per pound. And for those of you who are like me and don't want to do the math for this equation, we conveniently publish this factor on the actuarial information browser for each county under the Prices tab. This demonstrates how that price adjustment factor price slide works. If $2.60 per pound is the projected price for 650 pounders and the price adjustment factor is 0.0004, 4 cents per pound, then 200 pounders would be worth $3.06 per pound, and 750 pounders would be worth $2.49 per pound. Here are the projected price calculations, and in a couple of slides I'll show a slide that indicates which one of these calculations to use when, depending on the plan of insurance you elect. Some other things to initially gain from this slide are that the formulated price is used when establishing the production guarantee and uses the approved yield, whereas the adjusted price is used when calculating the production account and uses the actual yield. The other thing to notice on this slide is that the adjustment slide has a minimum of 200 pounds and a maximum of 750 pounds. Same story as the projected price. The next slide will say what to use when, but formulated is used for the guarantees and adjusted is used for calculating the production account. This slide shows which one of the calculations in the last two slides to use when. If you elect yield protection, then you'll use the formulated producer projected price to establish your production guarantee and the adjusted producer projected price to calculate the production account. If you elect revenue protection, the guarantee will be calculated with the formulated projected price if the projected price is higher than the harvest price, or the formulated harvest price if the harvest price is higher than the projected price, and we'll always use the adjusted harvest price for production account. If you elect revenue protection harvest price exclusion, the guarantee will use the formulated projected price and the production account will use the adjusted harvest price. So moving down the timeline, the next big item is the sales closing date, which is January 31st. That is the date you have to have signed up for a policy with an agent by if you want to have weaned calf insurance for 2024. I would highly recommend, if at the end of this presentation you're thinking that you're interested in taking out a policy for the 2024 crop year, to start locating and having conversations with an agent soon. And do not wait until the last day. It will make your and your agent's life less stressful. When you sign up for weaned calf, you'll fill out an application. On the application, you will list the county where you intend to raise calves. On the slide, you will see in red, list only one county per application. Do that, because this is a pilot and it's the first year. We expect to find some items that we need to fix for subsequent years. This was the first one of those we've identified. The policy has some language that would allow for multiple counties on an application that has the potential repercussion of costing additional insurance premium for some of those producers. So we have instructed all of the insurance companies, and they've trained their agents, that we need to list only one county per application. You can have as many applications as you need for the number of counties you operate in. You will also elect what coverage level you want, state your insurable share in those calves, and the plan of insurance that you want. We're only offering basic units, so unless you have multiple share arrangements, all of your cattle in one county will be insured together. The rest of this slide I'm going to cover in greater detail in upcoming slides, but you cannot have LRP feeder cattle endorsements for anything except dairy in the 2024 crop year, and you will also complete the pre-acceptance worksheet, often referred to as the PAW, every year, which will just include some basic information about your plan for the year and your operation. Weaned calf and livestock risk protection, often called LRP, have a complicated relationship. You can have an LRP policy and that's fine, but if you have taken out an LRP feeder cattle endorsement for steers weight 1, steers weight 2, heifers weight 1, heifers weight 2, Brahman weight 1, Brahman weight 2, unborn steers and heifers, or unborn Brahman, on or after July 1st, 2023, which is the beginning of the 2024 crop year, you can't have a weaned calf policy. Where the two play nice together is you can have LRP fed cattle, LRP swine, LRP feeder cattle for a dairy type, or LRP feeder cattle in another state, county, and on different calves. I also want to make a note here that weaned calf is a continuous policy. So if you take out weaned calf insurance in 2024, you would have a policy in 2025 unless you tell your agent to cancel it before January 31st, 2025, and you would be ineligible to buy an LRP feeder cattle endorsement for any of the excluded types until you've canceled your weaned calf policy. Every year that you have weaned calf insurance, you'll have to fill out a PAW by the sales closing date, which is January 31st. It contains just basic information about your policy, like where you plan to have cattle located, your number of cows, and your plans regarding animal nutrition and animal health. When you're expecting to start calving, and any changes that you're making in your operation from the previous year, like changes in implanting practices or creep feeding. I'm going to go over the pair in the next slide, but just know that some items on the PAW may trigger the insurance company to perform a pair. So the pre-acceptance inspection report, also known as the pair, is done by the insurance company and they must complete it within 30 days of the sales closing date, which again is January 31st. To complete the pair, the insurance company must inspect all cattle in all locations for the county on the application. It is essentially just the insurance company's opportunity to make sure that everything is in place for your operation to make sure that the calves being insured would have the potential ability to reach their guarantee. A pair is required for all new applicants, which for 2024 is everyone because it's a new policy, so everyone's a new applicant. Also, in future years, if you change insurance companies, when significant changes are made to your operation, if there's been damage to your water or pasture in the prior year, or if you answer no or none to the animal health and nutrition questions on the PAW, or additionally at the discretion of the insurance company. For new insureds, the records that will be required will be your application form, the PAW, and the pair that we just talked about, as well as your weaning weight records from the last 4 to 10 years if you have them, and they are applicable and deemed acceptable. For most producers, those records will be your sales tickets that show the number of head and weight when you sold them after weaning. Next, we're going to talk about production reporting and establishing your production guarantee. The production reporting date will normally be March 15th, but this year that falls on the weekend, so it was moved to March 17th. When establishing your production guarantee, for new insureds, we do have T yields available for those who do not have weaning history. For those that do have applicable and acceptable weaning weight records, those will be used to establish your production guarantee. However, for new insureds, those records are capped at 125% of the applicable T yield. After the initial year of coverage, those third-party verified records are utilized and the 125% cap is not applied as long as weaned calf coverage continues. But if you have a break in continuity, then those records become subject to the cap. Acceptable records must be verifiable, include the number of head and weight, and align with the requirements found in Part 4 of the Weaned Calf Insurance Standards Handbook and Part 14 of the Crop Insurance Standards Handbook. Also note that you must tell your agent by the production reporting date, which again is normally March 15th, but this year is March 17th, any changes in practices or other circumstances that may reduce the expected yield below the yield upon which the insurance guarantee was based. The insurance company may reduce your yield based on changes in practices if necessary. So here's an example of how the 125% of T yield cap will work. For this example, we're going to assume that the T yield is 500 pounds, which makes 125% of the T yield 625 pounds. So for crop year 2024, the producer brought in 9 years of records, and you'll see that every year that the producer average calf weight exceeded 625, it was capped. Then we average those 9 years weights and with the caps, and the producer's approved yield is 608 pounds. Then in 2025, they come back in, and their average weight was 670 pounds in 2024. That exceeds the 625 pound cap, but because it was an insured year, the cap is not applicable for that year's production, but remains in effect for the prior years. The then 10-year average gives an approved yield of 614 pounds. Then in 2026, they come back in again, and their average calf weight in 2025 was 582 pounds. So the cap is not applicable, but 2015 falls out of their database history because it's based on a rolling 10-year average, giving the producer an approved yield of 610 pounds for 2026. Next, we will talk about the calving period, which runs from February 1 to July 31st, and the final calf report. Calf reporting is probably going to be one of the most important parts of your participation in weaned calf. I would suggest that you find an agent you like working with if you have this program, because during calf reporting you'll likely be in communication with them frequently. Calf reporting begins when you notify your agent of the first calf born during the calving window, so the first calf born on or after February 1st. You must notify your agent within 3 days of that calf's birth that calving has begun. The calf report is a summary record of all live calves born at different times from the beginning of calving to the calf reporting date or final calf reporting date. And the calf reporting date is the earlier of 60 days after the date calving began for the unit, or August 1st, which is the final calf reporting date. Insurance attaches only to calves reported on the calf report. So 3 key takeaways. You have to notify your agent within 3 days of the first calf born after February 1st. We're only going to insure a maximum of a 60-day calving window. And a calf has to be alive to be added to the calf report, and insurance doesn't attach to them until they are included on the calf report. And if you don't have any insured calves in the county for the crop year, you must submit a 0 calf report. Your calf report must include all insurable and uninsurable live calves by type located in the county, the number of cows, an estimated number of calves that may be born after the calf report is filed. That way those calves are considered as uninsurable and not as underreported, which would have penalties and would potentially impact an indemnity. The date calving began for each unit, your land ID, share, and signature, and you may revise the calf report as often as required to report the birth of additional calves until the earlier of the calf reporting date, which again is 60 days after calving began on the unit, or the final calf reporting date. I would highly recommend revising your calf report frequently so that insurance is getting attached to those calves in case they die or some other covered peril happens. Reports can be made in person or by phone and confirmed in writing within 15 days. So one thing that is unique about cattle that we had to account for in this program, as opposed to row crop policies, is that cattle can move. If you're going to move your calves while they're still on the cow to another county in the pilot area, which is South Dakota, Nebraska, Colorado, or Texas, you must tell your agent and get permission from the insurance company. Your premium for those calves being moved will be based on the higher of the premium rate of the county listed on the application or the county they are moving to. If you're moving cattle to a county in a state outside of the pilot area, then it works just like the ones moving within the pilot area, only we've published a state rate for the additional 46 states in the actuarial documents, which will likely be higher than the county they are coming from, and that will apply only to the cattle being moved. If you're shipping cattle to another country, like Canada or Mexico, things get different. You have to give notice within 3 days prior to the date they're being moved, and that allows for things like making sure that weights can be obtained on those calves, and coverage ends on those calves once they're moved. Premium is based on the original county when they are moved to another country. We have had the question, what happens if I send cattle to Canada and then bring them back? Coverage on those calves ended when they left, and it does not reattach to them. So let's walk through some scenarios of moving cattle. You start with 100 head in County A with a 7% premium rate. In scenario 1, you move 20 head to County B, which is in the pilot area and has a premium rate of 6%. The receiving county's premium rate is lower than the originating county, so you would pay 7% premium on all 100 head. In scenario 2, you move 20 head to County C, which has a premium rate of 8%. That's higher than the 7% in County A, so you would pay a 7% premium on 80 head and an 8% on the 20 head that moved. In scenario 3, you move 20 head to an uninsured state outside of the pilot area, and the actuarial documents list that state's premium rate as 12%. You would then pay the County A 7% on 80 head and the County D 12% rate on the 20 head that moved. And then in scenario 4, you ship 20 head out of the country. You would pay the 7% County A premium rate for all 100 head, but coverage would end for that 20 head that left the country when they moved. If you're going to move cattle, you must provide notice to your agent telling them why you're moving them, where they're coming from, where they're going to, the number of head going, the number of head staying, and when the cattle that are moving will arrive at their new location. Next, we will review weaning, ending of insurance, and causes of loss. Insurance ends the earliest of total destruction of the insured calves, final adjustment of a loss on the unit, abandoning of the insured calves, putting the calves to an alternate use such as backgrounding, selling the calves, the calendar date the calves are weaned, moving the insured calves to another country, or January 31st of the year immediately following the sales closing date for the crop year, which for 2024 would be January 31st, 2025. The weaning weight report must be completed by you and verified by an acceptable, disinterested third party. Weights must be determined within 5 business days after weaning. A third-party verifier must be present at the time the calves are weighed. Scales must meet applicable requirements, such as being certified scales. A representative sample of the calves must be weighed to determine the total weaning weight of calves being weaned on each weaning date. So if you wean on multiple dates, you must take multiple weights. The minimum sample will be 20% of the number of calves being weaned, not to exceed 30 calves. Note: while the adjuster or AIP representative does not have to be present at the time of weighing, the adjuster or AIP representative has the final say in the number of calves weighed and other loss adjustment procedures. Here's a list of who qualifies as an acceptable third-party verifier for weaned calf. Auction, sale barn, and livestock exchanges, as well as AIP loss adjusters, will probably be the most common. But other acceptable verifiers are livestock commission representatives, county agricultural and natural resources extension agents, licensed vets, state extension beef cattle specialists, State Department of Ag, Animal Health, Livestock, or Measurement and Standards Division personnel, State Cattlemen's Association officials, and authorized Farm Service Agency personnel. Say you intend to background your calves for a period and do not have a way of obtaining weaning weights at the time of weaning. This is where the background adjustment report comes into play. It's completed by you and is used to document calculations and adjusting the average weaning weight of calves that are backgrounded after being weaned and before obtaining a weaning weight. Information on the BAR is used for the weaning weight report. Sale or weight documentation must be included, and the weight must occur no later than within 5 business days of the end of the insurance date, which for crop year 2024 would be February 7th of 2025. Feel free to pause the presentation if you want to walk through the steps of the background adjustment report. But simply what it does is it reduces the weight of the calves obtained at the end of backgrounding by 1.5 pounds per head per day post-weaning. Causes of loss that weaned calf will indemnify based upon are adverse weather conditions, fire, wildlife, earthquake, volcanic eruption, disease but not damage due to insufficient or improper application of disease-controlled measures, other causes directly damaging pastures and other forms of grazing, such as insects, provided that acceptable control measures were followed, calf death due to a covered peril occurring during the insurance period, which, remember, for it to be during the insurance period, that calf had to make it onto your calf report, but such as disease, freezing temperatures, flood, fire, hail, or predation, as well as change in harvest price from projected price for both revenue protection and revenue protection harvest price exclusion plans. So what wean calf is not going to cover are aborted pregnancies, stillborn calves, calves that die before your calf report is submitted, and failed conceptions. All four of those, that calf never made it into the calf report for insurance to attach to it. It also won't cover calves that you're required to destroy by order of an official governmental authority, calves that are seized or quarantined and are not released during the insurance period, calf death due to any causes while the calves are under quarantine, or calves that die while in transit. So if you're moving calves from, say, South Dakota to Idaho and they die on the truck, those calves also are not covered. In the event of damage or loss, what are your duties? First, protect the commodity from further damage by providing sufficient care. And then my advice would be second, call your agent. But in the event of a calf death, you need to establish that the death occurred during the insurance period, that it was due to an insured cause of loss, and provide acceptable documentation of the death with things like pictures. You also need to get consent from the insurance company before destroying any insured calves, putting any insured calves to another use such as backgrounding, abandoning calves, selling any of the insured calves prior to the date the calves would normally be weaned, or selling any of the calves other than through a sale barn or other established buyer. So if the neighbor kid wants to buy a few steers for their FFA project, you need to let your agent know so they have time to arrange to get weights and provide consent prior to selling those calves. Lastly, the premium billing date for the 2024 crop year is February 1st, 2025, after you have likely weaned and probably had a chance to market the calves. And if you don't pay your premium bill by March 31st of 2025, your policy would terminate and would make you ineligible to purchase crop insurance. Let's walk through a few examples. First, with the yield protection plan of insurance. The producer has a 600-pound approved yield per calf, a 75% coverage level, which gives them a 450-pound production guarantee per calf. They have 100 calves and a 100% share in price election. The premium rate is 5% and a 362-pound actual weaning weight per calf, but the loss is due to insurable causes. When calculating the liability, you would take the 100 calves times the 450-pound production guarantee per calf times the $1.64 projected price, and we would use the formulated projected price because it is yield protection, and that would give you a liability of $73,800. When calculating the premium, you would take the $73,800 times the 5% premium rate to get a $3,690 premium. So now we're going to go through the potential indemnity calculation for that example. Step 1 and 2 just calculates the liability we just established on the previous slide. And then steps 3 and 4 takes the 100 insured calves multiplied by the 362 average weight and multiplies that by the price. And because this is yield protection, we'll use the adjusted producer projected price. And you'll notice that the price is higher than the formulated price we used for the liability, and that's because the 362-pound calves are lighter than the 600-pounders we were expecting, and base the liability on. So the price adjustment factor uses the price slide to compensate for that. So we multiply the $1.83 per pound to get a total production account of $66,246. Then we simply subtract the difference to see that we are $7,554 less than the liability, and with a 100% share, you get an indemnity of $7,554. Now with a revenue protection example. We're still going to keep the 600-pound approved yield and 75% coverage level, which gives you a 450-pound production guarantee per calf and 100 reported calves and 100% share and price election, just like the yield protection example. The premium rate is 11%, and we're going to say 2 calves die due to insured causes, leaving 98 head remaining, and a 362-pound actual weaning weight per calf, with the loss being due to insured causes. So when calculating the liability, you're going to take the 100 insured calves, multiply that by the 450-pound production guarantee per calf, and then, because this is revenue protection, you're going to use the higher of the formulated producer projected price or the formulated producer harvest price. The projected price is higher, so we're going to use $1.64 to get a $73,800 liability. When calculating premium, you're going to just take the liability times the 11% premium rate to get a premium of $8,118. Now on the indemnity calculation, you would again take the liability, and then to calculate your production account, you take the 98 head that remain times the 362-pound average weight, multiply that by the $1.76 adjusted producer harvest price, which again is more than the formulated producer harvest price because these calves are lighter and the price adjustment factor comes into play, to give you a total production account of $62,438. You subtract the difference between your liability and production account to give you a total of $11,362, and with a 100% share, your indemnity is $11,362. And finally, with a revenue protection harvest price exclusion example, we still have the 600-pound approved yield per calf, 75% coverage level, 450-pound production guarantee, 100 reported calves, 100% share and price selection, with an 8% premium rate. The same 2 calves die due to insured causes, and you still have a 362-pound actual weaning weight per calf with loss due to insured causes. So when calculating the liability, you take the same 100 calves times 450-pound production guarantee, and then you multiply that by the $1.64 projected price, which is the formulated producer projected price, to get a liability of $73,800. And you take your liability times your 8% premium rate to get a premium bill of $5,904. For the indemnity calculation, you're simply going to take the liability, which is again is $73,800, and then you're going to take the production account, which would be 98 head times the 362 average weight per calf times the $1.99 per pound, which is the adjusted producer harvest price in this situation, to equal a production account of $70,597. In step 5, you subtract production account from the liability to give you $3,203, and with a 100% share, your indemnity is $3,203. To quote liability and premium at various coverage levels, You can either visit with an agent or use the cost estimator tool available on RMA's website at the address above, or from RMA's homepage at rma.usda.gov, select Tools in the banner at the top of the page, and then select Cost Estimator in the drop-down. If you need help locating an agent, you can go to the link at the top of the slide, or from rma.usda.gov, select Tools from the banner and then select Agent Locator. You will then enter in your location and any other search criteria you need, and it should provide you with a list of agents in your area. If you have any questions about weaned calf risk protection, you may email rma.kc.livestock@usda.gov. Also, at the web page listed, you'll find a section towards the bottom of the page with resources for weaned calf. Thank you for your time.